So you've probably heard that the trend is your friend, but here's the thing, and the reason why most beginners lose money. It's not because they can't find the trend, but because they don't know when to get in. Today I'm going to be showing you the simplest trend following strategy that you can start using right now, pullbacks to the 20 simple moving average. And in this video, we're going to be covering how to find the trend, how to know exactly where to enter, where to put your stop, how to manage risk, and even how to filter out bad trades so you don't get chopped up in all the noise. By the end of this video, you'll have a step-by-step plan that you can put into practice immediately. Just a reminder that Forex trading is very risky and that most traders lose money. This video is for educational purposes only. So before we even jump into the charts and before I even start with the strategy, I want to show you why this works. Markets move in waves. They move in uptrends, they move in downtrends, and then you get periods of consolidation. You want to think of an uptrend like climbing a staircase. So price pushes up, which is the rally. It then pauses, pulls back a little. That's your opportunity. And then it pushes up again. But most beginners make two mistakes here. They often try to buy too early in the pullback before the market has finished retracing, or they buy too late after the market has already gone, and then they get caught when the market reverses. And what I'm going to show you in this video is how to wait till the market has finished its retracement and then get into that move early enough that you make good profits on the way up or way down. So what I'm going to show you is a pullback to a dynamic reference point, the 20 SMA, so that you enter when the price is still in the value zone of the trend. But before we even start with any of this, we need to first ask ourselves, what is the market doing? You need to understand broadly what the market conditions are. So for example, is the market trending? And if so, in which direction? Or is it consolidating? And do you need to maybe stay out of the markets for a while? So if we're looking at an uptrend, for example, price makes higher highs and higher lows. And in a downtrend, generally you'll see price making lower highs and lower lows. Here we've got a Euro USD hourly chart, and you'll see how the price pushes up, pulls back to a higher low, and pushes up again. And in the beginning, you'll want to mark those higher highs and higher lows very clearly so that you can really see what's going on. And the golden rules are you only want to buy in an uptrend, you only want to sell in a downtrend, and you want to avoid consolidation or ranges because that choppiness will get your account blown faster than you know. So if you look at this uptrend here, you'll see I've marked the higher highs and the higher lows. And when you look at this, it's quite easy to see where good buying opportunities would be. And same in this downtrend, I've marked the lower lows and the lower highs. And again, it's very easy to see where good selling opportunities would be. Now I want to show you how to add the 20-period simple moving average. And because it's so widely watched, many other traders are reacting to it too. So here I'm using Paperstone's TradingView platform, and you basically go into indicators, you type in simple moving average, you click on that, and that'll appear on your chart. And from there, you'll see it starts out as a 9-period moving average. You go to settings, and then you can transform it into a 20-period moving average by changing from 9 to 20 over here. You can then, of course, make it thicker or thinner depending on your preferences, and so that you can see it very easily. I'm going to make it a purple 20 SMA. So in this uptrend that I'm showing you here, you'll notice that the SMA is sloping upwards, and you'll see that price is pulling back to the SMA and then bouncing off it. And you see this happening again and again. Of course, we're looking back in time here, so it's very easy to identify this in hindsight. But what you'll notice is you can actually pick this up quite early on in the trend too. And I'll get to some of those examples just now. Also, if you look at this downtrend, you'll see that the SMA is sloping down and then price rallies up to it before dropping again. Okay, so here's the general strategy. Number one, you're going to look at your market structure. You can identify whether you've got an uptrend, a downtrend, or if it's consolidating. We generally trade with an uptrend or a downtrend. If we get consolidation or sideways movement, we're not going to enter a trade. Number two, we're going to wait for a pullback to the SMA or the simple moving average. Number three, we're going to look for a confirmation signal at the SMA. So if you're in an uptrend, you'd look for a bullish engulfing candle, for example, or a pin bar rejecting the SMA. So you'd see a long wick and a short body, indicating that the trend is going to continue in an uptrend. You also could look for high volume bars, which also indicates that there is buying pressure. In a downtrend, you would look for a bearish engulfing candle, or you'd look for a pin bar with a wick to the top to confirm that the downtrend is continuing. Number 4, you'll enter at the candle's close. So once that candle has closed and you have seen that confirmation, that's when you place your buy trade in an uptrend or your sell trade in a downtrend. Your stop loss will be placed just below the swing high or swing low, the recent swing high or swing low, and your target could be 1.5 to 2 times your risk or the next support or resistance. So I also like to use the average daily range, and sometimes I use a percent of the daily range depending on how much the market's already moved in the day. But what's important here is that your risk-reward ratio is intact. You don't want to risk more than you stand to profit from the trade, because in the long term, that's a recipe for disaster. So optimally, you'd like to have a risk-reward ratio of 1 to 3, but a risk-reward ratio of 1 to 1.5 or 1 to 2 is also acceptable. And basically, this combo keeps you in line with momentum without you chasing price and getting bad entries. So now I just want to talk about some trades that you want to avoid if you're using this strategy. Not every SMA entry is going to be good for your trades. For example, if there's sideways price movement or consolidation, you really don't want to enter trades in, because what's going to happen is that you're going to get stopped out very often. And even if you're only risking a very small amount, those continuous stop outs are going to eat up your account very quickly too. You also want to avoid trading against the higher time frame trend. So for example, as you can see here, this is an uptrend on the daily time frame. And therefore, when you go down to the lower time frames, you want to avoid getting into sell trades, because the probability of them working out is not as high as if you were taking long trades with a higher time frame that is in an uptrend. And the other thing is you want to avoid trading during major news events. So many traders get caught out so quickly with news and the volatility that happens after a major news event. So avoid trading altogether during major news events unless you're more experienced and you know what you're doing. So I want to show you a real example. Here we have the Euro USD, and the structure on the higher time frame is higher highs and higher lows. So we know that we're basically looking for long trades. If we move down to the 5-minute time frame, here we again see higher highs and higher lows, and I can mark those out. We also see the 20 SMA sloping up, which is a good sign. Here we find price pulls back to the simple moving average, and then we see a bullish engulfing candle. So what I'll do here is once that candle closes, I'll enter long with a stop below the last higher low, and then my target will be 2 times the risk. Of course, in this trade, it hit the target and there was no guesswork involved. And this is not going to happen every time. But again, if you're managing your risk and your risk is much lower than your profit potential, then over the long term, you will generally be profitable. Trading is not a straight line where your equity curve just goes from bottom left to top right. Peter Lynch, who is one of the greatest traders of all time, said that if you're good, you're right 6 times out of 10. That's 60%. And even the best traders of all time will take losses almost 50% of the time. So here's the mindset shift. Stop aiming to win every single trade. Start aiming to keep losses small and to let your wins grow. That's risk management. And here's how it works in practice. Firstly, decide on a percent of your account that you're willing to risk with each trade. Most pros keep it between 0.5 and 2%, which is very low. So for example, if you have $1,000 in your account and you risk 1% of your account, that's $10 per trade that you're risking. Your stop loss placement will determine your position size, not the other way around. And what you'll find is that most trading platforms do this automatically for you. Now, I also want to talk very briefly about 2 types of edge. Number 1 is your win rate, which is how often you're right. But in the long run, it's actually very unreliable. And number 2, which is most important, is your risk to reward ratio. How much you're risking per trade. This is also how much you risk when you're wrong versus how much you can make when you're right. And this is the one we really care about. So for example, if you aim for a 1 to 3 risk reward ratio, you're risking $1 for every $3 that you could potentially make. So let's say you take 10 trades and you risk $100 each. If you win 5 trades, you've got $1,500 profit. If you lose 5 trades, then you've got a $500 loss. So the net result is $1,000 profit even though you were wrong half the time. And this is so powerful because it means that you can actually trade without having to be right all the time. You're trading probabilities. So remember that your entry gets you in, but your risk management keeps you in the game for the long term. So there you have it. Trend first, pull back to the 20 SMA, confirmation candle, and strong risk management. Do this consistently and you will be profitable in the long term, even if you're wrong half the time. Like, subscribe, and I'll see you in the next video. Thanks so much.